It's already deleted.
June 11th, another coffee talk with Kristel, and continuing our series on how investors really finance real estate. So good morning and welcome to Coffee Talk. Over the last few weeks, we've been talking about real estate investments or how to invest in real estate. And we talked about using equity. We've talked about analyzing properties. We've talked about mistakes investors make. But today I want to talk about something that stops a lot of people before they even get started, the financing. And the reason I choose this topic is because over more than 25 years in lending, I've noticed something interesting. Most people don't fail because they don't qualify. They fail because they assumed they couldn't. They disqualify themselves before ever having a conversation. So today I want to share a few stories and examples that might help you see financing differently. So investors are still buying. And the question is why? A few years ago, people were buying because money was cheap, rates in the 3s and the 4s. Some people still call me and asking, can I get this type of rates? No. So today, many investors, however, are still buying because opportunities are still there. They're still seeing opportunities. I'm seeing more sellers are willing to negotiate. Clients are purchasing with tens of thousands of dollars in seller concessions. The same properties are sitting on the market longer, so there's more room to negotiate. Seeing buyers who have done their homework and finding opportunities that weren't available during the frenzy. But here's what's really fascinating. The biggest obstacle, although many will think is the rate, is actually the mindset. Almost every week, someone says, Kristel, I would love to buy an investment property today. And when I ask, well, what's stopping you? Then they usually answer, because I don't think I qualify. Like the funny thing is, many of them actually never checked. And that's really my first story for you guys today. So a few years ago, I worked with a business owner, successful business, busy, making money. But when tax season came around, his accountant, his or her accountant, did exactly what accountants are supposed to do. What is that? They found deductions, lots of deductions. So when he looked at his tax returns, he assumed he would never qualify for another investment property. He already talked himself out of it. It's like, Kristel, I don't make enough money. I don't report enough. I make the money, but I don't report enough. Nowadays, there are so many opportunities and ways for self-employed to actually invest in real estate. The bank statement programs where we don't look at your taxes, no tax returns, no W-2s, bank statements, but specifically for investors, we have what's called the DSCR loan, debt service coverage ratio. That really means that the lender is looking closely at the property's ability to generate income, meaning how much is the property going to be renting for and how much is the mortgage? Is it 1-to-1? There are some thresholds that we can go lower and up and all that stuff, but just in general, 1-to-1. So instead of focusing on tax returns, on the net profit of a business, we are not focusing on the property. Will the property support the actual payment? Now, we still need to have your credit. We still need to go ahead and have whether you're a citizen or green card holder, things of that nature. But just suddenly the conversation changed. Instead of I can't qualify, the conversation became what property should I buy? Because like I said, you want to make sure there is a positive cash flow. And that's why DSCR has become so popular with investors and more people interested in starting investing, especially if you're self-employed. Even yesterday, a couple of days ago, I had a lady who she does event planning. I love her idea. She's an event planner. She's like, well, I'll go ahead and buy a property and I start renting it to do events. So now I'm not just planning it, I also have the space to hold it. So that was an interesting concept. She's self-employed. She does own a house, but she's not on the mortgage. So it gets a little bit complex when you're first time, but there are opportunities. So the key is speaking with a specialist like myself. So if you're self-employed, you're a business owner, you're an investor who's building your portfolio, people whose tax returns don't tell the whole story. This is where DSCR is helpful. Now, DSCR isn't the best option for everyone. Okay, it is a popular one, but that's why you really, again, want someone who helps you. What is your scenario? What is your situation? And what is your long-term goal with this? Because I remember speaking with an investor who came asking, especially because it's popular, and I was like, hey, can you tell me about this D something loan? Oh, you mean the DSCR loan? Yes. And when he asked, they say, because that's what investors are doing, right? And I kind of chuckled like, yeah, but it's not for everyone. It depends on your scenario. The truth is that it is a financial tool. The right tool depends on the job, depends on your situation. So we got to discover your credit. You do want to have a strong credit score. Now, in general, investment properties are going to be 15 to 20% down in your minimum. When talking about investments you're not occupying, okay? This is straight going to be a business transaction. You're going to be renting this property. 50 to 20%. 25% gives you even better terms. So you do need to have funds to purchase when you're going to do it as a DSCR. You do need to have strong credit. In general, you will need score of 680 and above, but we can do it with lower scores. But lower scores mean higher terms or worsened terms when it comes to the amount that you have to put down, as well as your interest rate. So I want you to explore more than just a DSCR. What is your goal with this property? How long do you intend to keep this property? Because many investors don't realize that the biggest difference isn't just always the interest rate. Sometimes it's the flexibility. For example, many conventional loans, I'm talking about the Fannie Mae, Freddie Mac, the traditional, they do not have what's called a prepayment penalty. The DSCR do. Often, to have a competitive rate similar to a conventional, where we will verify your qualification as an individual with your debt to income ratio, the DSCR would actually have a prepayment penalty. Well, that's okay. I can deal with that later. No, you want to know that now, right? Because you want to structure it where, like, for instance, right now with Glenda has a tenant, and she might think about selling this property in a year or two. I'm not going to put her into a prepayment penalty of 4 or 5 years to give her just a better interest rate and now have 5% of the balance as a penalty. No, we're not going to do that. We're going to go ahead and think about what is the best scenario for her. So some DSCR have zero prepayment penalty, but the rates are higher. Conventional in general, when I say conventional, Fannie Mae and Freddie Mac usually do not. So if you're planning to refinance rates improve or sell the property in a few years, the prepayment penalty becomes part of the conversation. The lesson is don't fall in love with a loan product. Fall in love with a strategy. So you need to know this information. You need to ask this information when you go to your lender. Or you come to a lender like myself, you come to me, and then I'll be able to cover it. Because I'll ask you, how long do you intend to keep this property? Is this a long-term investment? Okay, this type of rate, what your rent is going to be, and your mortgage, you may not have to refinance for a while, so at least the prepayment penalty won't impact you. So those are important conversations to be in alignment with your strategy. Okay. Another scenario I'm going to bring up for you guys. Let's imagine you have 4 investors sitting, having a cup of coffee. Okay. The first investor is a W-2 employee. Good income, good credit, buying their first rental. Their financing path may look very different than the second investor. Okay, we're talking about somebody who's a W-2, good income, good credit. Very often it's easier to go on a traditional conventional loan because there isn't as many restrictions, or it's easier, honestly, on a conventional loan when you're a first-time investor. Okay, not saying it's not possible, it's just might be easier. The second investor, having also a cup of coffee, he owns a business, makes excellent money, but writes off everything possible. The financing path may be completely different. Now, a third investor already owns a home, has built substantial equity. They may already be sitting on the funds needed for a down payment and they don't even realize it. Some of them can actually own so much equity that, or have so much equity that they can actually use that equity, if they qualify, to purchase some of the investment homes? Cash. Or a home that is may not pass a regular appraisal, fix it up and not refinance, take the money and do it all over again. So it depends on your strategy. Again, completely different strategies for investors, for goals, for different solutions. And this is why I tell people, the question isn't what is the best investment loan? The question is what is the best loan for your situation? So if there's one thing I hope you are taking away from this coffee talk is this. Don't decide you can't invest before you've explored your options. Today, I just talked about investors who are truly buying to rent a property or maybe flip it, meaning buying and eventually selling pretty quickly. But there's also the investor who's buying income producing property and moving into the house and having ADU. We've had those previous talks. Or an investor who's buying 3.5% multifamily, or an investor, because you're investing, right? You're putting money in this property to have a goal of earning a return on it. Not just, hey, I'm buying a home so I can be sitting my feet up and not expecting any income. Your mentality is investing in this property for a return. So whatever your situation is, you're a business owner, you're an employee of a company, you have a 401k, all of those scenarios, bring them to me. Let's talk about your goals in investing into real estate. And I may have a strategy and say, you know what, this home that you love right now, detach yourself emotionally from it. Keep it as a rental because you have a great payment, and let's go ahead and buy the next home that you will love. And you bring all the positive energy to it so you can make it happen again as another investment. There are several paths to investing in real estate. And the more you understand your options, the better decisions you will make. Really want you to detach yourself from, oh, it's my home. I love that, right? But think numbers as well. Are those numbers making sense? What can we do for the path ahead? So if you're wondering what options might be for you, let's have a conversation. Not so much about rates, about products, but about your strategy. What's your real estate investment goal? So I can bring you in alignment with that goal. That'll be future that looks like 5, 10 years, 15 years from now. So again, thank you for joining me on this coffee talk. I am Kristel, your Sacred Home with Kristel moments. Thank you so much for joining me. And I am trusting this information.